So, Geir, you gave a very interesting presentation as always. To what do you attribute the current high level of buoyancy in the market that you described?
Well, we're now defining this as the OSV owners and operators. And they have been riding a long curve of optimism, represented through improved financial accounts and a large amount of new contracting taking place in Norway, in the Far East, and clearly backed by sustainable high oil prices and a continuous positive E&P spending by the oil majors. And it seems that, I think my argument today was that in addition to the macroeconomics positives, there are other drivers which are clearly as important. There's an abundance of liquidity in the market, interest rates are low, and the shipyards are still quite eager to offer very good payment terms. And if you put all this together, there's obviously a lot of optimism among the players. My message has been that I think now it's time to be a bit more cautious, because projects are being funded which may not or should not have been funded because of ample supply of liquidity from existing and many new sources, including private equity. And given the fact that the oil majors are slowing down spending, their profitability is under pressure. And I believe also that the oil price is heading south. It is really time to enjoy the positives that are there, but take a step back and maybe consolidate, maybe reduce capex going forward, and try to basically build up a good backlog in terms of contracts and enjoy the cash flow.
So it's not so much a question of when is the market going to peak, but you believe it really has peaked and that owners perhaps need to be a little more prudent now, or perhaps lenders need to be more prudent too.
Well, lenders, I think this time around lenders have been prudent for a while, driven by the banking crisis. We still are very prudent and we're not giving the high leverage financings anymore. But that doesn't seem to stop the eagerness to contract because there are many other financing sources. But as you mentioned, that it's maybe time to hold back and consider the positions, because the reduction in E&P spending will have consequences. There's no doubt. And their intention is, of course, to try to change the equation in their favor to push down rates, and subsequently values may come down, actually.
And where do you think this might first hit? Would it be in what you describe as commoditized sectors like the PSV market? Is that perhaps the area most at risk, or are there others?
No, it's, I mean, the bigger parts of the offshore market is actually doing quite well at the moment. It's a fine balance, and it's important that we keep it that way. But the excesses are taking place in the jackup, the drilling sector, and the PSV sector is larger than, well, 4,500 plus. That's where we see excessive funds coming in. Those are the two most commoditized parts of the offshore market, where it's easy to get an entrance and easy to turn around and sell. And right now, there is too much money chasing incremental yields. Markets are wide open, capital markets. You see credits being able to, or companies being able to raise funds, which all things equal would not have been allowed to attract those funds, but it's happening. And that's another sign of maybe we are reaching some important points in time when we should be a bit more cautious.
Do you think perhaps the situation has been exacerbated somewhat by the Chinese banks coming into the market in a big way?
Well, it's I don't think they're in a big way yet, but they're certainly becoming much more visible. They were there to back up their own Chinese Inc. trades and owners. Clearly now they're going more international. So the money is flowing, yes, across borders, and is assisting clearly non-Chinese companies to attract cheap funds. And again, if they combine that with contracting in China, they have a very good mix of low contracting prices and good payment terms, which again adds to the slight concern about too much money coming into the market.
Right. Apart from the Chinese banks coming into the market and the other lenders that you've described, are there any obvious trends in the way that owners are arranging finance in this current market?
Well, the change is that banks are holding back on leverage, and tenor in particular driven by the bank's own difficulties in the past. While in the public markets they can actually achieve longer tenors, no amortization and higher leverage, which is attractive, although is sustainable. I think that you see a lot of the bond issues today have 3, 4, 5 years tenors, and then they are not amortizing. Clearly there comes a point in time when they have to be refinanced. If those windows are not open, many of these companies will have problems again doing the refinancing.
One other point that was inevitably raised this morning was the question of tapering and what effect that may have as and when it happens and to what extent it happens. But from the impression I gained was that the markets have actually built that into already. Is that your view?
Yeah, I mean, this has been in the pipeline for quite some time. Actually, we were hoping it would come much earlier because tapering off is actually a good sign. It means that the US economy is getting back on track again.
Yes.
So the fact that it's not happening slowly, I think, is a good sign. But the world market just have to adapt to it because they've been for too long softly supported by a steady stream of more cash coming in, which have driven down interest rates even further and produced more funds for investments, which is now actually seeing, I think, could be of concern going forward.
And one last thing here, are there any other macroeconomic factors that you think could conceivably upset this market? One of the things that was raised this morning was China. Is that a potential risk, the economic situation in China as a whole, a recession that might follow from something like that? Are there any other risks you'd identify?
Well, China, I mean, we all know that they've been driving the growth in GDP. They've been driving trade and shipments, seaborne trade, and clearly also oil imports and oil demand. Their own growth needs to come back. It's still very fragile. While the US is slowly coming back on track, we don't see that happening yet for China, and there's a lot of uncertainties implicitly in their domestic financial system. Another threat is, of course, shale, but more so on the gas side than the oil side. Gas has a much longer period of impacting how we consume oil versus gas. Short term, shale oil would have a negative impact, but it seems that the output is, over time, the next 10 years, is only estimated to be roughly 5 million barrels per day.
Right, that's somewhat less than originally projected, isn't it?
Much less, and we also know that the cost of production from shale oil is actually $85 per barrel, which is much higher than we thought. And the wells are running dry very quickly, so they have to move around all the time.
So not quite such a threat as originally foreseen.
Gas is the big issue.